Good morning. Welcome to our presentation on accounting treatment regarding operating segments and joint ventures. Our group is Group 3 and these are our group members. Okay. What we have done is we have taken 4 different companies in 4 different industry sectors and we have analyzed the level of compliance to recent accounting standard changes and how accounting is done regarding operating segments and joint ventures. We have also taken another company in each industry sector to compare with. The companies what we have taken are Quantas in the transport sector, Ramsy in the healthcare sector, Saracen in the resource sector, and Wotif in online retailing. And we have also taken Virgin, Sonic, Wotif, and Flight Center to compare them with. Let's first see how these companies differentiate their operating segments. We cannot see a clear pattern in the industry or among the industries the way they differentiate operating segments. For example, in the healthcare industry, Ramsy differentiate their operating segment by geographic location, and Sonic, the other company in the healthcare industry, differentiate operating segments by business segment. This can be due to the reason how reports are presented to their chief operating decision maker in the respective companies. Now let's see how the financial performance is measured in operating segments in these different companies. There again, we don't see a clear pattern in the industry or among the industries the way they measure the financial performance in operating segments. Now, for example, Ramsy, the healthcare industry, measure the financial performance of the operating segments by net profit after tax, and the other company in that same industry measure the financial performance by interest before interest, tax, and amortization. Then again, we don't see a clear pattern. Now I'll pass on to my group mate, Rebecca.
Hi, I am Purka Chen and I'm going to discuss segment analysis of compliance. We have picked 5 paragraphs of the standards to compare the companies. All 4 companies provide an explanation and general information about reportable segment as at paragraph 22. In paragraph 23, where identification of profit and loss was not met by Wotif, where only segment revenues are reported. In paragraph 22, profit, product and service was not met by Ramsy, where all revenues are combined for all service rendered. In paragraph 33, geographic areas was not met by Saracen, where revenue do not split into geographical locations. In paragraph 34, the major customer was not shown in any of the companies. It is acceptable if there are no customers who contribute the minimum revenues. However, it is advised that each entity should include it in the notes. The comparison of joint venture and joint arrangements. All entity elects to report as AASB 131 instead of only adopt AASB 11, where Quantas and Wotif report as equity method and Ramsy and Saracen report as proportionate consolidation methods. Among all, Quantas, Ramsy, and Wotif report them as jointly controlled entities, and in contrast to Saracen, which identify them as jointly controlled assets.
Hi, my name is Reese. So I'll be talking about the joint venture analysis of compliance between our companies. So the first thing to note is that at 30th of June 2013, Quantas actually do not have any remaining interest in joint ventures, so it's hard for us to therefore compare their compliance with the other companies. Now, AASB 131 is quite clear and says it requires any interest in jointly controlled assets to be aggregated between assets, liabilities, expenses, and revenues. Now, Saracen have jointly controlled assets as their interests, however, they do not aggregate between these different divisions. So there's no such requirement for jointly controlled entities to aggregate. However, both Ramsy and Wotif do aggregate into assets and liabilities. Now, where possible, the same GICS was used to compare certain companies, but with airline and healthcare GICS, they were not found to have any other companies with interest in joint ventures, so we were therefore not able to make any comparisons. So to conclude, based on this, joint ventures are not often used outside of the mining and consumer services industries. So similar to Wotif, Flight Centre report as per AASB 131, and they also use the equity method of reporting and classify their joint ventures as jointly controlled entities. Now they also aggregate similar to Wotif. Compared to Saracen, however, Altura, although they may also use the standard AASB 131 and use proportionate consolidation and jointly controlled assets, they do aggregate their assets, unlike Saracen. So they're more in line with what is required by the standard. So the pattern we can see from comparing the two different industries is that the mining industry tends to use jointly controlled assets to describe their joint interests and use proportionate consolidation, whereas each of the other industries use the equity method of reporting with jointly controlled entities. Now the reason we've concluded for this is that mining industry shares mineral resources with its fellow joint venturers that have a finite life and output produced is shared between the two entities. I'll now pass you to Maya to speak about the rest.
Hi, I'm Yon Chi. We examine the regulation of joint ventures and arrangements. We discovered that there are outstanding patterns in mining industries. A number of mining firms generally classify themselves as jointly controlled assets instead of jointly controlled entities due to its unique features of the business. For example, companies like Saracen, Fortescue, and Artra have not yet determined the effects of changing from proportional consolidation to equity method. The change from AASB 131 to 11 would be the significant concern in mining industry due to difficulties of the forecasting on expense on exploitation. On the other hand, other companies in different industry would not be significant concern since there is no substantial impact on their reporting. To sum up, we found that there are multiple evidences that the quality of the disclosures provided in financial statements can be different substantially within different GICS or the same GICS. For example, we found that there's outstanding patterns in joint ventures within mining industries, and within the operating segment report, companies tend to report depending on chief operating decision maker internally, which leads to great variance in their report. We found that there's more room for improvement in compliance for the segment reporting. However, joint ventures are reporting in compliance with relevant standards. Thanks for listening our presentation.